Welcome. Today we're going to be talking about Form 17. What is it? How does it work? When can you, as a property investor, use it? Hi, I'm Kimberly Shapcotts, qualified chartered accountant with over 15 years experience, property investor and entrepreneur. Let's sit down and have a chat. Form 17. What is it? Why do we care? Well, Form 17 is great if you're a married couple. It's a way of moving your property income to make it fit for you as a couple, especially if one of you is a higher earner and the other is potentially a basic rate earner or even not using their full personal allowance. So, how and when do you need to do this? In order to use a Form 17, which basically changes the income that is allocated to each individual on their personal tax return, what first needs to happen is we need to make sure that the property is owned as tenants in common. Now, many individuals that I speak to have bought a property that is now rented out and it's actually owned as joint tenants. Now, what this means is you both own the whole thing, but you own 50% of the whole thing, but there's no defined 50%. What we need to make sure is that the property is owned as tenants in common, which means you own your 50% and your spouse owns the other 50%, which ultimately means if anything were to happen to you, half of that property would go wherever you wanted it to go to and wouldn't automatically be passed to the other party. Now, that is a very crucial step that needs to be taken if it isn't already in tenants in common. The other important factor for a Form 17 is this is a form that is applied for married couples. So you need to be legally married. If you fit both of these criteria, then Form 17 becomes in play. Now, the deemed rules say that if you buy a property, you will automatically have 50% of the income and the other party will have 50% of the income. Now, for some couples, that's not a problem. You might both be basic rate taxpayers or both be high rate taxpayers. But when you have differing income brackets, so one might be a stay-at-home parent and the other is a 40% taxpayer. Now, if you're not fully using your personal allowance and the other is paying tax at the higher rate, then you're going to be losing out because one of you is going to be paying 40% on the rental income you're receiving and the other is going to be paying no tax on the rental income you're receiving. Whereas if all of that rental income was diverted to the lower taxpayer, the stay-at-home partner, then that one would not be paying any tax, or if they did become taxable, it would be at the basic rate band of 20% rather than 40%. So this is a great method of moving your income to maximise the tax brackets to make sure that you're not paying more tax than you need to. Now, obviously, it's not all completely straightforward and there are a few steps that you do need to take and everything does need to be done properly and legally. So the first thing that will need to be done to enable a Form 17 to be completed is you will need to arrange to get a declaration of trust. Now, I'm not the person to talk to about a declaration of trust. It's a legal document and you can go to a solicitor and they will be able to arrange this document for you. However, when you've got this document for you, which is basically telling the other party how the property is going to be owned from that point forward, this document can now be used as evidence for the Form 17 to actually show how the income is now to be split. The process that you need to go through to then get the Form 17 in place is you will need to send the Form 17 completed, which shows the split of the income based on the Declaration of Trust, with a copy of the Declaration of Trust to HM Revenue and Customs. Now, the Declaration of Trust and the Form 17 need to be done within 60 days of each other. So you'll need to do the Declaration of Trust and then get the Form 17 completed and sent over to HM Revenue and Customs. Now, the 60-day time limit is a definitive time limit, so it does need to be done in quick succession. If the form is late, then the whole process will need to be completed again because the declaration will be deemed invalid. So it is important when you start this process that you get it worked through efficiently and effectively. Also, a declaration cannot be backdated or dates change, so therefore you can only apply this updated change after the point that you've had the declaration put together. So the sooner you get this process started, the sooner you'll be able to split your income in a differing way and start to save some tax. So how long does the declaration last? Well, the declaration lasts all subsequent tax years until a change is made. Now, there's only a couple of circumstances where a change might happen. That's if a couple permanently split or divorce, if one of the spouses unfortunately passes, or you actively make a change. At this point, the declaration would become invalid, and to do something different, you would need to do a new declaration. Obviously, when this declaration is no longer valid, the deemed point becomes relevant again, and you are deemed to have 50% of the property each. There are some other considerations to make that are not really tax related, but something that you should be aware of, such as if you've got a mortgage secured on the property, is there any issues in regards to that? This will obviously affect the individual's wills, so again, just something to be aware of depending what the plan is with that property. If you get divorced, this may have an impact on how the assets are split during these proceedings. And things like capital gains tax will be impacted by this split, so that might have an impact on any reliefs that you may have available or utilising your full capital gains tax allowances. So there is a few other considerations to make, but look at the bigger picture and see what is going to be best for you as a couple and where things are going to be going moving forward. A final point to note is that this will need to be done on each property that you own. It cannot be done as a group endeavour. So if you've got a number of properties, you may want to do a declaration of trust on a few of them and do a Form 17 on a few, or you might want to do it on all of them. So speak to your solicitor to see how you can deal with that from a declaration of trust point of view, and then you'll need to do a Form 17 on each of the properties to make that declaration. Overall, it's a great planning tool, and it's definitely a way of reducing the tax in a household. So have a look at what you think is best for you and your family, and then if there's any questions, please comment in the box below. Hopefully today you've learned how Form 17 can make the most of your property income. If you have any questions on this, then please do comment in the box below and check out the description where you'll find the link to HM Revenue and Customs to find more information and how to make that application. Please like the video and please do subscribe to the channel to keep up to date on your property, tax and accountancy related topics. If there are any topics you would like to be covered, then please do comment in the boxes below. Let's make tax less taxing. Let's make tax less taxing.